The Dutch grocer's American adventure and accounting scandal. How Ahold built an empire on borrowed time. In 1887, Albert Heijn opened a small grocery store in Oostzaan, Netherlands, selling tea, coffee, and spices to local customers. What began as a humble family business would eventually grow into Ahold, one of Europe's largest food retailers and a major force in American supermarkets. By the early 2000s, Ahold operated over 9,000 stores across multiple continents, owned iconic American chains like Stop & Shop and Giant Food, and generated revenues exceeding 66 billion euros annually. The company's aggressive international expansion strategy had transformed it from a Dutch corner shop into a global retail powerhouse that employed more than 350,000 people worldwide. But beneath the impressive growth figures and international success story lay a web of financial manipulation and fraudulent accounting practices that would bring this retail giant to its knees in one of the most spectacular corporate collapses in European history. Albert Heijn's son, also named Albert, took control of the business in 1910 and began the transformation from local grocer to regional chain. The younger Heijn understood that success in retail required more than just quality products. It demanded efficiency, innovation, and scale. In 1948, he opened the first self-service supermarket in the Netherlands, revolutionizing Dutch shopping habits and establishing the company as a pioneer in modern retail practices. The Albert Heijn chain, which would become Ahold's flagship brand, introduced numerous innovations including one-stop shopping centers, private label products, and sophisticated supply chain management. By the 1960s, Ahold had gone public and was expanding rapidly across the Netherlands, acquiring smaller competitors and building new stores at an unprecedented pace. The company's early success was built on genuine operational excellence, customer service innovations, and a deep understanding of changing consumer preferences in post-war Europe. The 1970s marked the beginning of Ahold's international ambitions under the leadership of CEO Ab Heijn, Albert's grandson, who recognized that the Dutch market alone could not sustain the company's growth aspirations. In 1977, Ahold made its first major international acquisition by purchasing the Spanish supermarket chain Cadena, signaling its intention to become a pan-European retailer. However, it was the company's entry into the American market in 1981 that would define its trajectory for the next 2 decades. Ahold's acquisition of BILO, a southeastern U.S. grocery chain with 97 stores, represented a bold bet on the world's largest retail market and demonstrated management's confidence in their ability to compete against established American giants like Safeway, Kroger, and A&P. The American expansion strategy was based on acquiring regional chains with strong local market positions, improving their operations through Dutch retail expertise, and then using them as platforms for further growth. The 1980s and 1990s saw Ahold embark on an acquisition spree that transformed it into one of America's largest food retailers through a series of strategic purchases that seemed unstoppable. In 1987, the company acquired Giant Food Stores, a Pennsylvania-based chain with a strong presence in the Mid-Atlantic region, for $750 million. This was followed by the 1996 purchase of Stop & Shop, the dominant New England supermarket chain, for $2.9 billion. Giving Ahold control of 213 stores and a leading position in one of America's wealthiest regional markets. The Stop & Shop acquisition was particularly significant because it established Ahold as a major player in the highly competitive Northeast Corridor and provided a platform for further expansion along the eastern seaboard. Additional acquisitions included Tops Markets in upstate New York, First National Supermarkets in New England, and Edwards Superfood Stores in New York, creating a network of over 1,400 American stores that generated billions in annual revenue. By 2001, Ahold's U.S. operations employed more than 140,000 people and accounted for approximately 60% of the company's total revenues. Under CEO Cees van der Hoeven, who took control in 1993, Ahold adopted an increasingly aggressive growth strategy that prioritized rapid expansion over careful integration and operational excellence. Van der Hoeven, a charismatic leader who had previously worked at McKinsey & Company, believed that scale was essential for survival in the global retail industry and that Ahold needed to reach 100 billion euros in annual sales to compete effectively against giants like Walmart and Carrefour. This philosophy drove the company to pursue acquisitions at an unprecedented pace, often paying premium prices for target companies and taking on substantial debt to finance the purchases. The pressure to meet ambitious growth targets created a corporate culture where executives were incentivized to deliver impressive financial results regardless of the underlying business fundamentals. Van der Hoeven's compensation was directly tied to earnings per share growth, creating personal incentives for financial engineering that would later prove disastrous. The complexity of Ahold's international operations, combined with ambitious growth targets and inadequate internal controls, created an environment where fraudulent accounting practices could flourish undetected. The company's joint ventures, particularly with South American partners like Disco in Argentina and Santa Isabel in Chile, became vehicles for manipulating financial results through questionable consolidation practices and inflated revenue recognition. Ahold began consolidating joint ventures where it owned only 50% or less, allowing it to claim 100% of revenues while reporting only its proportional share of investments on the balance sheet. This practice artificially inflated both revenues and profit margins, making the company appear more successful than it actually was. Additionally, Ahold engaged in promotional allowance fraud with suppliers, where agreements for marketing support and volume discounts were manipulated to accelerate income recognition and smooth earnings fluctuations. The company's complex international structure, with operations spanning multiple countries and currencies, made it difficult for auditors and investors to detect these irregularities. The fraudulent practices extended beyond international joint ventures to include systematic manipulation of vendor agreements and promotional allowances that inflated profits by hundreds of millions of dollars. Ahold's American subsidiaries, particularly the food service division led by Jim Miller, engaged in elaborate schemes to manipulate vendor allowances and promotional agreements. These practices involved backdating contracts, creating fictitious promotional campaigns, and recognizing future promotional allowances as current income. The food service division, which supplied food to restaurants, hotels, and institutional customers, was particularly aggressive in these practices, with executives creating fake promotional agreements worth millions of dollars to meet quarterly earnings targets. Internal emails later revealed that Miller and other executives were fully aware they were engaging in fraudulent accounting practices, but continued because of intense pressure to meet Wall Street expectations and maintain Ahold's stock price. The fraud was so systematic that the company had created detailed procedures for manipulating vendor agreements and training programs to ensure consistent implementation across different business units. By 2002, the financial engineering that had sustained Ahold's growth story for years began to unravel as external pressures and internal investigations exposed the extent of the company's accounting irregularities. The first warning sign came when Ahold's auditors, Deloitte and Touche, began questioning the consolidation practices for joint ventures and demanded changes that would significantly reduce reported revenues. Simultaneously, a routine internal audit of the food service division uncovered suspicious promotional allowance agreements that led to broader investigations of accounting practices across all business units. The company's stock price, which had peaked at over €30 per share in 1999, began declining sharply as investors grew concerned about Ahold's ability to meet growth targets and service its substantial debt load. In October 2002, Ahold announced that it would restate its financial results for previous years due to accounting irregularities, sending shockwaves through the investment community and triggering investigations by securities regulators in both the United States and Netherlands. The full scope of the fraud became apparent in February 2003 when Ahold revealed that it had overstated earnings by at least €500 million over several years, forcing the resignation of CEO Van der Hoeven and CFO Michiel Muurs. The company's stock price collapsed to below €3 per share, wiping out more than 90% of shareholder value and threatening the company's survival as banks called in loans and suppliers demanded cash payments. Ahold was forced to implement a massive restructuring program that included selling its South American operations, closing underperforming stores, and laying off thousands of employees to preserve cash and reduce debt. The company's American operations, which had been the crown jewel of its international expansion strategy, were put up for sale as Ahold retreated to its core Dutch market to avoid bankruptcy. Criminal investigations in both the United States and Netherlands led to prison sentences for several executives, including Jim Miller, who was sentenced to 7 years in federal prison for his role in the food service fraud. The Ahold scandal represented one of the most dramatic corporate collapses in European history and served as a cautionary tale about the dangers of growth at any cost strategies in the retail industry. The company that had started as a small Dutch grocery store and grown into a global retail empire with operations on 4 continents was forced to abandon its international ambitions and focus on rebuilding its reputation and financial stability. While Ahold survived as a company and eventually returned to profitability under new management, it never regained its position as a major international retailer. The scandal highlighted the risks of aggressive accounting practices, inadequate internal controls, and executive compensation systems that prioritized short-term financial results over long-term business fundamentals. For American consumers who shopped at Stop & Shop, Giant, and other Ahold chains, the company's near collapse demonstrated how even the most successful retailers could be brought down by financial engineering and fraudulent accounting practices that had nothing to do with their ability to serve customers effectively.